Hi, this is Tom Porcelli, Chief US Economist at PGIM Fixed Income, and I'm here with James Sonne, our head of government affairs. And we figured we're around a year, the anniversary mark from an SVB perspective, Silicon Valley Bank, it failing. And we figured what a great opportunity to pick James's brain to see where we are from a regulatory perspective on the back of that bank failure. So James, great to be with you.
Happy to be here.
Awesome. So it's been a year since SVB went down. What's been on folks' mind in Washington, D.C. since then?
Well, it's interesting. Initially, when this happened, there were several proposals on Capitol Hill that got a lot of headlines and received a lot of talk and attention. The most prominent was the Recovering Executive Compensation from Unaccountable Practice Act, called the Recoup Act in short. And what this bill would do is it would provide clawback authority for the FDIC to clawback compensation from bank executives who did not meet certain risk management standards. There also, among other things, was an opportunity in this legislation that would allow the FDIC to actually remove certain folks at banks that are exhibiting risky behavior. At first, this got a lot of attention. Even Republicans in the Senate were generally supportive of it. But since then, with all that's going on Capitol Hill, whether it be international funding, social issues, government shutdown, it's been lost in the shuffle. And I don't think it will get voted on this year, but it is still an idea that is out there and a concept that is out there that I think could come to us in a future Congress. Go ahead.
No, please continue. This is great.
And then the other big issue I thought that still gets some play is the concept of changing the deposit insurance limit from $250,000. Sheila Bair, a former FDIC chair, was pretty vocal about floating this idea shortly after the SVB crisis began. Unfortunately, or maybe fortunately, depending on how you look at it, the idea of using government funds to better insure folks who had significant amounts of money in the banking system didn't really strike the right consumer-friendly, helping the average American political chord. But as we'll see in our discussion, the issue of insured deposits and the quality of the deposits is one that I think will still get a lot of policy proposals going forward. It just won't be this one on the Hill.
So, I think that naturally begs the question, right? I think there's always this rush. Something like this happens, DC swoops in and they want to make all these changes. But what really has a chance of really sort of sticking and what can you sort of see going away?
Yeah, that's a really good question. I think one thing that will eventually result in regulation that will probably be greater than just the banking industry is looking at the role of social media in these types of bank runs. This bank run was unprecedented in size and in scope and in its speed. And one of the main contributing factors, as I think Chair McHenry, the chair of the Financial Services Committee, said quite a bit, was the way social media kind of grinded the gears and moved things faster. So I think that there will be some more talk and eventually some kind of industry beyond banking type of regulation that will look at that.
So I guess if I was to think about, and James, you know this better than me, so you tell me. But I feel like DC always has some ideas in their back pocket, and so I wonder if were these ideas that we're talking about today, were they generated because of SVB, or were they sort of already out there and SVB is just a sort of a good catalyst to sort of get them into being enacted?
So I think the quality of deposits and how to have deposit insurance in a way that addresses the systemic risk concerns has been kind of a long time topic. I agree. And then I think this crisis certainly highlighted the problems that can exist when deposits move very quickly out of one bank or from one regional bank into larger banks and all the systemic issues that can come from that. So I think the short answer is yes, this has been talked about a lot, but now as we are moving forward to a one-year anniversary, regulators are very much thinking about ways to address liquidity concerns in the regional banking sector.
So does that mean that you get a setup where regulators become better regulators of banks, or do they just become, do the issues just become more onerous? Because I think that there's always a fine line that DC policymakers are trying to strike there.
Yeah, that's a fair point. It depends who you ask, of course. There has been a lot of criticism about the supervisory controls of SVB and Signature Bank, and regulators in the supervisory roles being asleep at the switch. So I think there's going to be a lot of changes, and there have been a lot of changes as far as day-to-day supervision of banks. What I think will come next, though, has to do with liquidity concerns at these regional banks. Most recently, both acting comptroller of the currency, Michael Hsu, as well as Fed Vice Chair, have made some speeches that, while certainly haven't been promising policy reforms, have pretty strongly hinted at ways to very surgically regulate liquidity at these types of banks, not big, huge banks, but at these types of banks, in a way that is looking to address future SVB issues. I don't think they'll stop every crisis, but given that there was a crisis and that Congress has failed to pass any substantive legislation, it would be very surprising to me if regulators didn't come up with something to address this issue. And in this case, the main one around liquidity will have to do with the use of the discount window at the Federal Reserve. Some folks actually think that it should be like pressing a button and banks should be able to access that discount window, no problem. A lot of banks have indicated that there are operational issues with that. And then more so in academia and in the media, there have been a lot of concerns about the stigma that could result from using that discount window. So we don't have a perfect plan yet, but that's certainly one of the main ideas that's out there for now.
Yeah, the stigma is real, by the way. I mean, I worked at the Federal Reserve for a number of years, so and I'm an economist, so I stay on top of those topics. It's I think something that to me, that strikes me as an uphill battle to really try to remove the stigma. But officials down in DC, at the Fed in particular, I think have really been trying to sort of push that idea, particularly I think in the wake of some of these bank stress points that we've been seeing. We'll see if they're successful or not in that.
Yeah, I agree with you. I mean, I think if you're running a bank and you're starting to see some signs of risk that could hit the whole system, the idea of raising your hand and saying, please let me use that discount window doesn't really help what your objectives are at that moment in time. The other issue is, well, of course, like I said, we're probably not going to have this widespread change in the deposit insurance coverage.
Yep.
What I do think is being talked about now, and will be something that's going to be considered in the next few months at the regulators, has to do more with looking at the liquidity credits that would be provided to various different types of deposits.
Right.
There's been a joint agency statement that has talked about risks of certain types of crypto deposits, hurting effects from hedge fund deposits. And I think the solution's not there yet, but I think we are coming to a solution where all deposits are not actually created equal. And
Right.
given what has happened here with this crisis, I think there is some appetite, and there will be some proposals coming soon that will talk about that.
So if I was going to ask you one last question, it would be this. It's an election year. How much of this is sort of, election year dependent? How much of this, if there is a change come November, does this continue to push forward? Does it get scaled back? I mean, what's your take on that?
So right now, any kind of regulation coming out of even the independent regulators has to have a very pro-consumer bent. It's why, for example, saying let's increase the deposit insurance limit above $250,000 falls flat on its face in a soundbite from policy perspective. Right. So those kind of ideas won't work. But the idea of arming banks to have more requirements for liquidity, I actually think does fit the Biden administration's somewhat pro-consumer narrative. And I think that they'll want to get these rules out sooner than later, because you're right. Once we're closer to the election, we don't need these topics being like a huge topic of debate from a public policy perspective, because they're complicated and they're really easy to twist to a different agenda if another opponent wants to do so. I think then, to answer your second question, if there's a change in administration, I do think that they'll be back to the drawing board with a lot of these types of proposals. If you look at the folks who are in the Trump administration in the past, a lot of them have a lot of experience with regional banks. One of them is now running a bank in New York that has recently shown signs of distress. So I think the attitude and the ability to work with industry and accommodate industry without maybe putting the consumer at the highest priority from a public affairs perspective is likely.
Awesome. This was absolutely fantastic, James. Honestly, I think that it sounds like there's a lot of ground to cover between now and November and even beyond, right? It almost sounds like it doesn't matter what the outcome is ultimately going to be come November. It sounds like there's still a lot of work in front of regulators to sort of address some of these issues.
Yes, absolutely. And I mean, a couple questions, or at least one question for you.
Yeah, please.
When we've talked all about, and we've heard policymakers talk about what happened with SVB and what may happen with future regional banks, the issue of commercial real estate investments comes up. Do you see that as a systemic risk? Do you see that as something that these banks can handle? Or where do you see that going?
Yeah, so this is such a hanging slider for me. So thank you because it gives me the opportunity to promote another podcast that we're actually pulling together with Jason Pan, who's our sort of resident CRE expert, and Dave Jang, who's our banking analyst. And we're actually interestingly enough, we're going to be recording that, I think, even today. Although today we'll take on different meeting since this has to go to editing still. I'll let the editors figure that one out. Yeah, so look, I think the bottom line is, I don't think there's a one size fits all response from the markets in particular, right? It would just depend on a host of different factors. But I think Jay Powell, Fed Chair Jay Powell, he made a really useful comment recently, and he basically said, they don't view this as a systemic event. And I think if you listen to our podcast with Jason and Dave, I think they're going to come to the same conclusion. So I would look out for that, hopefully soon.
We'll look forward to hearing it.
Awesome. Well, James, again, thank you so much. I think this was great, and we'll look forward to catching up with you maybe later in the year as some of these programs gather some momentum, or not.
Great. Thank you.